The week is slowly drawing to a close as we open a window at what next week has in store for the markets. On the monetary front, we note the speeches by BOJ Governor Welter and ECB Chief Economist Lane on Monday, the release of the Fed's Beige Book on Wednesday, the speech by SMB Chairman Jordan, and on Friday, the speech by RBNZ Governor O. As for financial releases, on Monday we get Germany's C4 figures for May, on Tuesday we get Australia's final retail sales rate for April, and the US consumer confidence figure for May. On Wednesday, we get Australia's composite leading index figure and CPI rate, both for April, Germany's GfK consumer sentiment figure for June, and Germany's preliminary HRCP and CPI rates for May. On Thursday, we get Australia's building approvals rate for April, Sweden's and Switzerland's GDP rates both for Q1, Switzerland's cough indicator figure, and the Eurozone's final consumer confidence figure for May. The Eurozone's unemployment rate for April, Canada's business barometer figure for May, the US second GDP estimate rate for Q1, and the US weekly initial jobless claims figure. On Friday, we begin with Japan's Tokyo CPI rates for May, Japan's unemployment rate and preliminary industrial output rate both for the month of April, China's MBS manufacturing PMI figure for May, France's final GDP rate for Q1, and France's preliminary HRCP and CPI rates for May, followed by Turkey's quarterly GDP rate for Q1, the Eurozone's preliminary HRCP rate for May, the US PCE rates for April, and ending of the week is Canada's annualized GDP rates for Q1 and March. The USD is about to end the week high against its counterparts. On a political level, we note that recent polling data has the two nominees for the US presidential elections neck to neck at key swing states. On a macroeconomic level, the US dollar gained on Thursday following the release of the US's preliminary PMI figures for May, but also the drop of the weekly initial jobless claims figure. However, traders may be more interested in the release of next week's core PCE rates for April, which are the Fed's favorite tool for measuring inflationary pressures. On the monetary level, the release of the FOMC's last meeting minutes tended to highlight the predisposition by policymakers to maintain interest rates higher for longer. In particular, policymakers highlight that domestic data releases over the intermeeting period pointed to inflation being more persistent than previously expected, which reaffirms our aforementioned interpretation that the Fed may keep rates higher for longer in order to ensure inflation returns to the bank's 2% inflation target. Therefore, following the release, the dollar tended to gain, and should we see Fed policymakers reiterating the bank's message that there is still some way to go before any rate cuts, we may see the greenback gaining further. The pound is about to end the week unchanged against the USD, yet stronger than the JPY and the euro in a sign of general strength. On a political level, we note that the starting gun has been fired for a UK general election. In particular, on Wednesday, UK Prime Minister Sunak announced that a UK general election would be taking place on the 4th of July. According to Politico, the opposition party Labour is leading by roughly 20 points currently. The announcement appears to have been spurred by the release of the UK's headline CPI rate for April, which came at 2.3% year-on-year, which, despite decelerating less than expected, was significantly lower than the previous reading of 3.2% year-on-year. Therefore, easing inflationary pressures and a possible utilization of the element of surprise appear to have made the decision to call an early election much more favorable. However, despite the CPI rates coming in lower than the prior readings, the higher than expected rate seems to have aided the pound. On the flip side, the retail sales growth rate for April showed a deep contraction. On a monetary level, we emphasize that according to Bloomberg, the BOE has cancelled its public speaking engagements as a result of the snap elections, and thus volatility in the pound may increase in the coming month. The JPY is about to end the week lower than the US dollar, the euro, and GBP in a sign of a wider weakness. Japan's macroeconomic outlook continued to darken as the nation's trade balance figure for April showcased a wider deficit than what was expected. Furthermore, Japan's CPI rates for April came in lower than the previous readings, implying that the bank's current monetary policy is sufficiently restrictive in order to combat inflationary pressures, which may add more obstacles to BOJ's efforts towards a monetary policy normalization. On a fundamental level, let's not forget that another market intervention by Japan to the yen's rescue is always possible should JPY slip even lower. Also, on a fundamental level, we know JPY's dual nature as a safe haven and a national currency. Should the tensions in the US-Sino trade relationships escalate further, we may see the yen gaining some safe haven inflows. Last but not least, we highlight BOJ Governor Wedder's speech on Monday, as interest rate differentials of BOJ with other central banks, and especially the Fed, seem set to remain wide, thus continuing to encourage traders to sell the yen, which in turn may prompt the BOJ governor to intervene verbally in the markets to the yen's rescue. Yet it remains to be seen if the market believes him. The common currencies are about to end the week in the reds against the US dollar and the GBP, but higher than the yen. On a political level, the elections for the new EU Parliament are set to occur in 2 weeks' time, which tend to provide some uncertainty for the path of the area ahead on a political level. On a monetary policy level, the market's expectations for the bank to start cutting rates in its June meeting seem to be intensifying and could weigh on the euro. In particular, we note the comments made by ECB Vice President de Guindos on Thursday, in which he stated that a reduction of 25 basis points would be a prudent approach. On a macroeconomic level, we note the release of the preliminary PMI figures for May, and especially the indicator for Germany's manufacturing sector, which came in higher than expected, implying an improvement of economic activity in Germany, aiding the euro. However, traders may be more interested in next week's preliminary HICP rates stemming from Germany, France, and the Eurozone as a whole for May. Should the HICP rates showcase easing inflationary pressures, it could provide some leeway for the ECB in the event that they wish to cut interest rates in their next meeting, which in turn could weigh on the euro. However, mixed readings or even an acceleration of the HICP rates could provide support for the euro, as pressure on the bank to remain on hold may increase. AUD is about to end the week weaker than the US dollar. On a fundamental level, we highlight the close economic ties between Australia and China. Thus, should US-China relationships deteriorate, we may see the Aussie taking a hit as well. In particular, we are referring to the war games which China began on Thursday around the island of Taiwan. On another fundamental note, we note the release of China's MBS manufacturing PMI figure for May, which should showcase a wider expansion in economic activity in the manufacturing sector. It could be implied that the demand for raw materials from Australia may increase, which could support the Aussie. Next week, however, Aussie traders may be more interested in the release of Australia's CPI rates for April, where should it come in higher than the previous reading, thus implying increasing inflationary pressures, it could further support the case for RBA to keep the financial environment tight or even tighten it a bit further. On a monetary note, the aforementioned theory about the possibility of raising interest rates was highlighted by RBA's May meeting minutes, which were released this Tuesday. On a more fundamental level, we note also the riskier nature of AUD as a commodity currency. Hence, should the market sentiment in the coming week turn more cautious, we may see AUD slipping, while a more risk-oriented market approach could benefit the Aussie. It was a rather easygoing week for loonie traders, although we should point out that Canada's core retail sales rate for March has yet to be released, and thus may influence the loonie before this week comes to an end. On a fundamental level, we note that oil prices seem to have moved slightly lower since the beginning of the week, which may have not been so helpful for the loonie. Given Canada's status as a major oil-producing economy, should oil prices start rising, we may see the loonie also getting some support in the coming week. On a macroeconomic level, we note the release of Canada's CPI rates for April last Tuesday, which came in as expected, thus showcasing easing inflationary pressures in the Canadian economy. Therefore, with inflationary pressures seemingly easing, it could ease the pressure on the BOC to maintain the current interest rate level, and thus could have weight on the loonie. For next week, loonie traders may be interested in Canada's GDP rate for Q1 and business barometer figure for May. As closure, and in a more general note, we expect in the FX market the US dollar to increase its influence over other currencies in the coming week. In turn, that may allow for a more influential dollar to overshadow financial releases stemming from other countries by taking the spotlight. On the other hand, US stock markets seem to have benefited from the improved market sentiment. It's characteristic that all three major US stock market indexes formed new all-time highs during the week. The earnings season has now come to a close, with the darling of Wall Street, Nvidia's beating earnings expectations once again. Should the positive market sentiment be maintained, we may see additional support for US stock markets building up in the coming week. Also, we note that the negative correlation of the US dollar with gold's price being present this week, given the weakening of the US dollar on the one side and the rise of the precious metals price to new all-time highs. We expect the negative correlation of the two trading instruments to be maintained, and should the US dollar move higher, we may see gold's price weakening further. On another note, the death of Iran's president has rattled some participants last Sunday, as the nation's constitution demands an election to be held after 50 days. Thus, should we see an internal power struggle in Iran, it could influence commodities, in particular oil and gold. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So this week's webinar will be on multi-time frame trading strategies. And before we get started, just a risk warning as per usual. Our products are traded on margin and carry a high level of risk. And it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie Chong, and I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. So we're going to look at which time frame is the most important, how you can take a top-down approach, what you should look out for on the higher time frames, zooming into lower time frames, and then we'll look at how you can craft your strategy. Okay. Okay, let's get started. So firstly, before we get into everything, we're just going to do a really quick recap on the basics of trading. Okay, so firstly, we'll look at support and resistance. So it's basically the price at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, or you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So we're gonna briefly look at this today, and then we'll get into I'll show you guys in a little bit why we're going through this before we get into the multiple time frames. Yeah, so it'll make more sense in the next slides. Okay, so I've added an image here for you to see how we can use swing highs and lows as resistance and support levels. So you want to take note of how there are clear peaks and troughs in the market structure, in order for them to be used as support and resistance levels. So let's first take a look at an incorrect example. So here's an example of insignificant swings, which are bad points to use for any kind of levels. So be it your support and resistance levels or starting points for your Fibonacci. Price movements over here are way too small and there are no significant swing highs or swing lows. Okay, so here's another incorrect example. So there aren't really any clear swing highs or lows and price movement is relatively small. Okay, so now here's a correct example of significant swings. So there's a really clear move up and down with obvious peaks and troughs and clear market movements. Here's another example. So I've drawn out the peaks and troughs to point out exactly how clear your charts should look like. Okay, so you can take these support and resistance levels as profit targets or stop loss levels, but you should not use it as an entry if there are no other supporting arguments such as Fibonacci or other graphical levels to support your analysis. Okay, because using a recent swing high or low is a weak level if that is the only level. Okay, so if there are at least two swing highs or low levels lining up nicely, then it's a much better level to use. So you want to try to find areas where these might line up. So it doesn't have to be exactly at the same level. So long as it's about a similar area, that's good enough. Okay, so one way to try and find these multiple swings is to try and see how far you can pull back your resistance or support levels. Okay, so as you can see in the GIF, it's okay to cut through these tiny wicks, but you typically would want to avoid cutting through the bodies of candlesticks. Okay, so now let's look at what other things to look out for when inputting a support or resistance level. Okay, so picking the starting point, you want to look for, or rather a pivot entry. You want to look for support or resistance levels, and there are a couple of rules. So firstly, you want to check if there's a swing high or low, pullback or overlap level to start from. Okay, so I mentioned earlier that we want to try and pull back the level as far as we can. Intersecting the wicks is preferred. You can refer to this image here. So you can see this green thumb is obviously that it's recommended, which means basically because it cuts through only the wicks of the candlesticks. These are okay because even though it does cut through only the wicks, it's not that preferred because there isn't a very clear swing high or swing low over here. Okay, so preferably we want to look for intersections that we will see in the coming slides. So for example, here we have a red thumb here. And the reason for that is because it cuts through way too many bodies of the candlesticks. So you can see the green thumbs here cuts through just the wick of the candlestick, which is preferred. Okay, so just basically want to look for a nice clean cut and not something that's messy like this one here. Okay, so another example here. Take note of this red highlighted area because you want to avoid intersecting so many candlesticks. Even though you might be able to argue that over here it's just the bodies, or rather it's just the wicks of the candlesticks, but it's way too messy over here. Okay. Okay, next. So here's what a clear market structure looks like. Fibonacci retracements can be used in both choppy and trending markets, but it is important to look for a really clear market structure even before you get started on your actual analysis. Okay, so like for example here, this is an example of an unclear market structure. So you can see it's very messy, it's really difficult to conduct your analysis on. So this is typically something that you want to avoid. Okay. So which time frame is the most important? So one important thing that we can do to our analysis to adjust the time frames so that the market structure is clearer. So here we have an example of an unclear market structure. Okay, so this is on the 15-minute time frame, and you can see it's really messy. There's no clear movements in price. But if you change the time frame that we're looking at to 1 hour, this is what we have. And you can see the highlighted portion has much clearer movement. So it's way easier to conduct your analysis on the H1 instead of the M15. And both of these is on the same asset that we are analyzing. Okay, so there's two criterion that you should look out for. Firstly, a clear swing low or swing high. And secondly, a really clear trend as well between the starting and the ending point. Then your Fibonacci retracement or your analysis is more likely to be accurate. Okay, okay, so now let's look into a brief intro into our multi-time frame analysis. So now we've gone through what you should look out for and how you can kind of adjust your time frames so that your charts appear clearer. So let's look at what other things you can use with your multi-time frame analysis. So it basically involves analyzing the market from multiple time frames, and it can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the time frame. Typically, traders will tend to choose at least two time frames. So that would probably be a shorter time frame and a longer time frame. The shorter time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall trend and market direction. So once the time frames are selected, the trader will then analyze the market from each time frame, looking for key support and resistance levels, trends, and patterns like we've done earlier. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, then it could indicate a strong uptrend in the market. So obviously, if you're a trader, this would be really helpful to make your trading decisions. So for example, if the short-term trend is bullish, then you might look into buying on dips or pullbacks in the market. Conversely, if the longer term trend is bearish, then you might look to sell or short the market. Okay, so it basically helps you to kind of zoom out and look at the bigger picture, analyzing trends and patterns from multiple time frames. Okay, so what should you look out for on the higher time frames? Firstly, we have the key graphical levels. So basically the horizontal levels that we looked at previously, how to identify your support and resistance levels, which is why we went through them before we started this. And then, of course, being able to identify your trends using trend lines and trend channels. Thirdly would be breakouts. So breakouts of these trend lines or trend channels or any of the support and resistance levels. Big moving averages, 50, 100, 200, golden cross or death cross. Ichimoku cloud also helps you to identify changes in trend or continuations in trend as well. And big Fibonacci levels that we mentioned earlier, such as your retracements, your extensions, projections, so on and so forth. And lastly would be price action. So price action basically is the past, present, and future. And you're trying to look at your momentum from the previous bar to dictate your strategy. Okay, so these are the different types of trading on the higher time frames. So for trend trading, it involves identifying and trading with the prevailing market trends. So traders would tend to enter positions in the direction of the dominant trend and hold them until the trend shows signs of reversal. This strategy often involves the use of technical analysis tools to identify and confirm trends. Next is swing trading. So, swing trading refers to capturing shorter term price swings within a larger trend. Traders tend to enter positions at swing highs or lows and take profits as the price moves in their favor. So, for swing trading, this strategy typically will involve holding your position for several days to several weeks, because you are trying to take advantage of the price oscillations. Okay, and then thirdly, breakout trading. So this involves entering positions when the um, price breaks through key support and resistance levels. So as a trader, you would tend to look for strong momentum and volatility following a breakout and aim to profit from continued price movement in the breakout direction. So this for breakout trading, it involves a little bit more careful analysis and of price patterns and the volumes to confirm your breakouts. Okay, lastly, we have mean reversion trading. So this is based on the idea that prices tend to revert to their average or equilibrium levels after deviating from them. So traders would identify overbought or oversold conditions and take positions with the expectations that prices will eventually revert. So this would typically involve you using a couple of technical indicators, so like your RSI, your stochastics, in order to identify these potential reversals. Okay, so if we look at the lower time frames, there are also different kinds of trading methods. So firstly, we have scalping. So this is a high frequency trading strategy where traders aim to make quick profits from small price changes. So they open and close multiple positions within a short period. And sometimes it could even be as little as seconds or minutes, um, as long as they catch small price differentials. So scalpers often rely on technical analysis indicators such as your moving averages or oscillators to identify short-term trading opportunities. For day trading, it involves opening and closing positions within the same day without holding positions overnight. So day traders would focus on intraday price movements, and they typically make multiple trades during the day. So they aim to take advantage of more short-term trends or volatility using technical analysis tools, chart patterns, real-time market data for trading decision making. Third, we have momentum trading. So this focuses more on capturing strong price movements that's driven by increased buying or selling pressure. So in order to do this, traders normally will look for stocks or assets that exhibit significant price momentum and then enter positions in the direction of the prevailing trend. So the kinds of tools or indicators that you would use would be something like your RSI or moving average convergence divergence or MACD to identify momentum opportunities. And lastly, we have news trading. So news trading involves taking advantage of significant market moves that result from news events or economic data releases. So traders will closely monitor the news, announcements, and enter positions based on the impact of the news on the market. So they aim to capitalize on the price volatility and rapid market reactions that occur immediately following news releases. Okay, so now that we know the different kinds of long-term and short-term trading, and we also know how to identify significant swings and use them as support and resistance levels, let's take a look at how you can craft your strategy, depending on, your lifestyle and what are the different kinds of time frames that you might choose. So starting off with scalping, this is obviously for a shorter time frame. So this kind of trading is fast-paced, it's exciting and mind-rattling. And there's obviously short time periods between the opening and closing of a trade, but you grab very small amounts of pips. You're also risking a very small amount of pips as well. So it does depend on your own um, your risk tolerance. But it allows you to take advantage of market volatility and you're able to avoid known unknowns. So your locus of control, because you're looking at 20 pips versus a 200 pips. And there are new opportunities every time you open the chart. Okay, so the holding time tends to be from a few seconds to a few hours. If you are trading, what we typically recommend will be 1 hour in the morning, 1 hour in the afternoon, and 1 hour in the evening. But it is important to have proper risk management so that you don't need to monitor the trades all the way. Okay. Now let's look at the three powerful scalping strategies. Firstly, we have the horizontal pullback strategy. Then we have the Fibonacci retracement strategy. And lastly, the Nike tick strategy. So firstly, horizontal pullback. Basically, this is what we call pullback. So when price um, So you can see firstly there is this resistance. It's a swing high resistance with 3 swing highs. So you can see that price has broken out of this resistance level. It's surpassed it, but we're expecting it to pull back or retrace back to this level. That's why we call it a horizontal pullback strategy. So this is what we call a pullback support because we are expecting price to bounce off of this level. A pullback resistance is something like this. So you start off with a swing low support level, and then price breaks out of that support level, and we're expecting it to retrace back to that level. Okay, so if we're looking at an example on the charts, here we have an example with Ichimoku. So the Ichimoku cloud, how you typically would use it is if price is moving below the cloud, then it's an indicator that price is in a bearish momentum. But if price is moving above the cloud, then it is in a bullish momentum. So in this case, we have this swing low here, and price bounced off of it. It has broken out of it, surpassed it, and now we're expecting it to come back to that level. Okay, and you can see that's exactly what happened here. Okay, so now if we're looking at a Fibonacci retracement strategy, you should remember that your Fibonacci trend line must follow price structure clearly. Even though the trend line can deviate from price structure, it shouldn't deviate too much. So in the example that you see here in this GIF, you can see that the line that's been drawn, this orange line, it is basically the shape of price structure, but our Fibonacci trend line cuts through the entire shape. So this is something that we want to avoid. Okay, so if you're new to Fibonacci, and I have a couple of questions on that in the chat. Um, I'll just show you guys this website that you can use. I think we've previously gone through the Fibonacci series on these webinars, but if you've missed that, not to worry, you can go ahead and look it up on theforexarmy.com. Okay, so yeah, that's theforexarmy.com, and then you can take a look at this trading guide, which is pretty comprehensive. It gives you a bunch of examples, some videos as well that you can watch. Yeah, so it's everything that we went through today, and it gives you a more in-depth understanding of how to use the different Fibonacci techniques. So like your retracements, how to draw them, what to look out for, how to find confluence areas as well. Yeah, so you can go ahead and take a look at that. If there's time at the end of my slides, I might briefly go through some of these techniques. Okay, but if not, yeah, you can just take a look at this website. Okay, let's get back to my slides. So the tool that we're using here is the Fibonacci retracement tool. And there are a couple of levels that we're looking out for. So here you can see we're looking out for the mid-range. So 23.6, 38.2, 50%, 61.8, and 78.6. Okay, but even though the tool is the Fibonacci retracement tool, it leads us to 3 different types of Fibonacci expansions. Okay, so firstly, we have a Fibonacci retracement plus pullback. So this is the pullback that we just talked about. You have 2 swing lows here. Price has broken out of it, and we're expecting it to pull back to this level here. Okay, we also have this retracement. So take note of how closely this trend line follows the shape of the price structure. And over here, you can see our 61.8 lines up nicely with that pullback level. Okay, I also have another Fibonacci level. This is also a Fibonacci retracement. So it's from the upper swing high all the way to the lower swing high here, or swing low. Okay, so in this case, the 50% lines up nicely with that level. So we have two Fibonacci levels lining up with a pullback resistance. So we're expecting it to reverse off of this area here, which you can see is exactly what happened. Okay, if you're wondering why we chose this level as our I guess as our support, is because it's an overlap level, which basically means there is a swing high here and a couple of swing lows that line up in the same level. Okay, so that's why we are expecting price to be attracted to such areas. Okay, let me know in the chat if you guys have any questions as well. Next, let's look at this example, which is another Fibonacci retracement plus pullback, but this time we are also adding in a Ichimoku cloud. Okay, so here we have a descending trend line, but it's not exactly a valid trend line because it doesn't have, we need at least 3 touches on the trend line to be considered valid. You can see over here, we don't have that. Okay, so we're expecting price to bounce off of that level, off of the trend line again. We also have this Fibonacci retracement from the swing high to the swing low. And our 38.2 lines up at the area where we're expecting price to bounce off of. Okay. In this case, we are also using two indicators. Yeah, okay, let's look at this one first. The first indicator we're using is an Ichimoku. So you can see price is just about moving above the Ichimoku cloud, which is a bullish signal. Now, if we look at this slide, you can see our stochastic is giving us this hidden resistance level, which basically means that we're expecting price to also respect that area, like it did here. So you see we have one resistance level lining up with another over here. Even though price is making a lower high on our stochastic, it's remaining at this resistance level. So this is the second time that it's happened. I'm expecting it to happen again another time here, which you can see that's exactly what happened. Okay. Okay, so let's move on to our last strategy. So this is what we call a Nike tick strategy. So just to recap again, we have so many levels for 1, 2. Again, the tool we're using here is the Fibonacci retracement. So the Fibonacci retracement, we have the levels that are above 100, the mid-range levels, and the negatives. So the negatives we call Fibonacci expansions. But now for Nike tick strategy, we're going to look at the extensions. So for extensions are the levels that we use that are more than 100%. So that would be 127.2 and also 161.8. So here's an example. You can see the yellow arrows show us the shape of the Nike tick. So our starting point is over here, basically the head of the arrow or the shorter part of the tick. So you should make sure that price fully breaks out of this 100% before you go in and use this strategy. So our 161.8 is the projected level at which we are expecting price to reverse off of. Okay, you can see that's what happened here. That's basically what we are looking for. Any reversals off of either the 127.2 or like we see here, 161.8. Okay, so here is a GIF of what we are looking for and how it works. So we firstly want to see if it's going to break out of the 127.2 level. And if it doesn't, then we go in and expect there to be a reversal at the 161.8 instead. Okay. Okay. Let's move on. So for the Nike tick strategy, we typically would recommend these timeframes. So the M30, H1, H4. Entry criteria would be if price breaks out of the 127.2. Okay, so we're using a stop loss at 145%, idea invalidation at 138%, break even would be 11% of the recent move, 50% take profit will be 11% of the recent move, and a full take profit is if there is 22% of the recent move. Okay. So you can see the levels that we are using here. The bonus, we are also using all of these levels. So let me get into them now. So firstly, let's focus on the Nike tick. I think you guys can kind of get the idea now. You can see the shape of the tick. So we're looking at the 127.2%, which price has reversed off of. For the Fibonacci projection, we are looking at this level here. This shape rather, this flash kind of shape. And it's also 3 points. 3 points would be the starting point, middle point, and ending point. And you can see that we have a 100% lining up at that level. Okay, so the 100% lines up nicely with our 127.2. Okay, and that is our kind of our Fibonacci confluence area. So since we have two levels lining up, we call that a confluence area because it's more validation that price is likely to reverse off of that area. Next, Fibonacci expansion. Okay, no, we don't have that here. But why we mention support and resistance is because at this swing high, if you draw a horizontal line across, we're actually expecting price to bounce off and hit back to that level, which is why we have highlighted this arrow to hit back towards this area. Okay, so here's a long example instead. Again, you can see the shape of the Nike tick. In this case, it's an upside down tick, or rather an inverted Nike tick. So the head is from here, starting point here, ending point here, and the tail is here. So we're expecting price to bounce off here, and it did. So it bounced off this confluence area. Again, the confluence area is the 127.2 Fibonacci extension or Nike tick. And then we also have this 61.8% Fibonacci projection. So for the projection, just to recap again, the starting point here, middle point here, and ending point here. Okay, so it lines up and we can see price shot up after that. Okay, so another thing to maybe take note of is this minus is what we call our Fibonacci expansions. So for Fibonacci expansions, we're looking at these two numbers, the minus 27.2 and the minus 61.8. So you can use these levels as well to determine where we expect price to bounce off of next. After this reversal, you can see that there is this flash shape or lightning bolt shape. So it's very similar to your projection, which also uses a lightning bolt shape. So you can use these two Fibonacci techniques together, and you can see once price reversed here, we expect it to reverse off of the minus 61.8, which you can see it did. Okay. Okay, let me know if you guys have any questions. Okay, if not, I think we still have time to do a bit of live analysis. So you can let me know in the chat if there are any, if there are any specific charts that you'd like me to go through. I think we might have time to just go through one. Okay, let's go through gold. Okay, can you guys see my charts? Okay, so on our weekly time frame, so like I mentioned earlier, we want to start off with our higher time frames and then work our way down to the lower time frames so that we get an idea of where prices are headed towards. So on our higher time frame, we can see this ascending, can definitely see price moving in this in an uptrend. Okay, so we're gonna see if we can find any ascending trend lines or trend channels to support that. Okay, I think I kind of can see, oh, can see this ascending trend channel. Okay, so what makes a valid trend channel is if there are at least two touches on top and two touches below. So let's look at our daily time frame now. Okay, and let's go in with some levels. Okay, so to start off, I think I have a Nike tick shape here. Okay, I'm gonna try and zoom in so that you guys can see. So the shape, the Nike tick shape is like this. Okay, and I can see that price is approaching my 161.8 level. So I'm gonna place a resistance level over there. This is my first resistance. My first support, I'm just gonna place it here at that swing high. Okay, so this is what we have on our daily time frame. So let's look at our 4-hour time frame now. Okay, on our 4-hour time frame, you can see we have this swing high lining up nicely. And this is a resistance. Okay, I'm not sure if we have any Nike tick levels here since it's so small. Okay, no. If we keep this Nike tick shape here as well, you can see the shape like this. Okay. Can see the 161.8 lines up with our first resistance as well. Okay, and I'm just gonna place our first support at this 127.2 level. Okay, next I'm gonna be looking um for some retracements. Also, this is my first support. And at this level, it's in line with this 38.2. Okay, so this is my second support level. Then I'll see if I can pull it back some more. Okay, so overall we have a pretty bullish uptrend from our weekly as well as our daily time frames. So we're expecting prices to continue to move upwards. So let's take a look at some indicators to support that. So I'd like to use Ichimoku and MACD first because at one glance you can see exactly what the signals are. So price is moving above Ichimoku cloud, so it's giving us a bullish signal. MACD is also giving us a bullish signal. If we look at Bollinger Bands, you can see it is also giving us a bullish signal. RSI. Actually, Bollinger Bands is not giving us a bullish signal. If I zoom in, it's not peaking above the upper band. So I'm gonna remove this. If we look at our RSI, it is moving in the overbought area, which might be a signal that it's going to drop. So let's take a look at some other indicators. Let's look at stochastic. Okay, stochastic is moving in an ascending trend line, which could suggest that it's going to move higher as well. Okay, let's look at one more indicator. Okay, so MA cross recently occurred, okay, which suggests a change in trend. So over here, you see that price is kind of ranging in this area. Recently it crossed, which could suggest that it's going to move higher. Plus, prices are moving above both of the MAs, both of the moving averages. So it is still giving us a bullish signal. Okay, so I'm going to move my RSI because it doesn't support our analysis. Okay, so we're expecting it to continue to move higher towards our 161.8 and this swing high level here. Okay. Are there any questions? Okay, no worries. Okay, if there are no other questions or other requests, then I think that's all for today. Thank you so much for joining me, and I'll see you guys again next week. Thanks, everyone. What do you mean with toy? So basically, you click on this symbol, and let's say we are analyzing Euro USD, for example, right? And then, so depending on which broker you're looking at, click on it. And I like to start off with a clean chart. So it will look like this. Um, if that's what you mean. Time frames are over here. Indicators here. If we're talking about Ichimoku, or rather Fibonacci, the Fibonacci is this one. This is the retracement. So like this. This is the projection I was talking about earlier, which has 3 points like this. Um, oh, So for your support and resistance levels, I just basically use this tab here, this moving tab, which has these horizontal rays. And when you click on it, it's actually blank, but they do give you the option over here on this icon to choose whether, what you want to label it as. For indicators, we have starred these, but you can look up. There are so many indicators out there, so depending on what you are comfortable with, for example, maybe pivot points, we didn't star. So if I'm looking at pivot points, I might star this as well, and then it will show up in my favorites here. But you can just search it here in the search bar. Sample resistance 1, we have them preset. Okay, for example, this. Do you mean the template? Oop. Mm, oh, for indicators, you set favorites, for example, pivot points with this star here. Yeah, add to favorites, and then it'll show up in this column here. For this template, I'm actually not too sure. Oh, like this. Save drawing template as, and then you type resistance 1, resistance 2, save, and then I think it will show up here. Okay. You have any other questions? Okay, we'll see if we can do a full session on how to use TradingView. But yeah, thank you so much for joining me. Thank you for the questions. Have a great rest of your week, and I'll see you again next week. Thanks. Bye.